Hello, Marc Ostwald from ADM Investor Services International, with some thoughts this week on financial conditions, not only in the US, but how they've evolved around the world. The picture is certainly not unitary, and some thoughts on how that plays out into markets' reaction function at the current point in time. My first chart is of the Fed's balance sheet. As we can see at the latest report from yesterday, the Fed's balance sheet is now 6.4 trillion. I think the important thing really is to realize just how much the Fed has injected relative to the global financial crisis 2008-9 and at what speed. It's the speed at which it's expanding it and the fact that we're still nowhere near probably the peak in that. There are some estimates out there ranging between $9 and $12 trillion, which would really emphasize just how much money the Fed is throwing at financial markets. The next four charts are all about financial conditions, and that expansion of the Fed's balance sheet really is to emphasize a very simple point. As much as US financial conditions have not tightened, this is my second chart, as much as they did back in 2008-9, and there has been a reasonable recovery since the Fed basically started basically doing whatever it takes and whatever is necessary to keep financial markets going. We still have a fairly tight set of financial conditions at -3 on that index. The picture in Europe is interesting insofar as the tightening of financial conditions. This third chart emphasizes that actually, as much as they have tightened, the tightening and the recovery basically have not been nearly as emphatic as they were both in 2008-9 and 2011-2012 during the height of the euro crisis. The next chart is on the UK, again emphasizing really that the measures that the Bank of England's taken really hasn't eased financial conditions that much. And I really wouldn't want to put that down to the fact that there is the additional concern about Brexit and the Brexit negotiations. I think that's by sheer dint of the fact that in an uncertain market, a secondary currency, such as the UK's pound is in the global economy, has to fight its own battles as opposed to the likes of the US and the euro area, which have a much bigger uptake. The fourth and final chart is an interesting one because it's the one for financial conditions in Asia ex-Japan. I think it really emphasizes that actually financial conditions have been on a bit of a modest roller coaster ride over the past 10 years, but have never really tightened nearly as much as they did back in 2008-9. And obviously central banks there, as much as they've taken a lot of measures, haven't actually needed to apply as much as the G7 central banks. So where does this leave us? I think the first point to make is the Fed may be looking at this as keeping markets, and indeed all other central banks, I should emphasize, keeping markets and credit flows going. However, when one looks at the performance on my final chart of the S&P 500 relative to the US 10-year yield, really what it emphasizes is that low rates wherever you are, as much as they may be necessary in the face of this huge uncertainty that we have globally, basically encourage bubbles. And at some point, we are going to be faced with the challenge that the Fed, the ECB, and the BOE, and the BOJ, and all the various other central banks are going to try and fashion some sort of escape. And building an ever bigger chasm between the financial economy and its reality and the real economy and its reality is going to prove to be an extraordinarily large challenge. There will be a bill to pay at some stage, and Panglossian delusion is certainly not the best way of approaching that. Those are the thoughts for this week.